have decided to sell out of most of my stocks and transition over to ETFs. The majority of my portfolio right now is invested in ETFs, and that's what I plan to do in the future, as I think the market it's a little bit expensive at the moment and there isn't a lot of great companies to buy at a good price. Now, if I already own the companies, why would I sell them? Well, the thing is that those companies that I own, they went up in price rather quick and I made a lot of percentage return in a quick time. And usually when that happens in my portfolio, it tends to drop afterwards. So I'd rather just take my profits, use that money to reinvest in something that's gonna give me profits regardless in the future, at least more likely than not. And then when I try to find value plays, I'll invest in those companies. Like for example, I'm still invested in Pfizer. As you can see, this company is about 22% of my portfolio, which is way too much. I'm trying to rebalance my portfolio to where this company is less than that. My total return, it's negative 283, so I'm losing about $283. I am making some dividends and I'm also starting to sell calls, so I'm getting a little bit back of that income, and then in hopes that this stock in 2 to 5 years will overcome the current price that it is and give me some profits, and then I'll close out of this as well. Before I show you which ETFs I invested in, let me go over the stocks that I have left in my portfolio. Another one of them is going to be Comcast. I think this company is undervalued, although not by a lot. I think there is some room to make some money here. It's only 2.97%, or you could say 3% of my portfolio, and it pays a nice dividend yield of 4.05%. Although there isn't a straight correlation, the only reason I'm buying Realty Income at the moment is because I think below the $55 mark is a good investment. Not only that, the Fed is cutting down interest rates, and I think this will help out real estate in the country overall. Therefore, I think in a couple of years, if interest rates keep dropping, this company is going to be performing. Hence, it's only 5% of my portfolio, a few shares, and I'm also getting a great dividend of 5.39%. If interest keep cutting down, this stock will most likely go up. Just make a few bucks there, close it, and reinvest it back into ETFs. Another company that I've been investing in is going to be UPS. I've opened and closed this position so many times just because I think below the 90 mark, it's a great buy, but over like 100, 105 is just a complete sell. I know that kind of does not make sense, but in my analysis, in my thesis, it kind of makes sense. So whenever this company drops below 90, I'm buying. Whenever it's over 105, 115, I'm selling. That's it. It's about 11% of my portfolio, and it pays me a great dividend of 7.79%. Guys, when you start adding this dividend yields to the ETFs yield, you're gonna see it's gonna be a very decent return. It's gonna be nothing crazy, but you're still gonna be doing a lot better than the S&P 500, which is kind of my goal with this portfolio. I don't really want to make 300%. I just want to be better than the S&P 500. Then we have QFIN Holdings. I think here I made a mistake. This is a Chinese company. The numbers are great, but since it's a Chinese company, just because of political news, this company is gonna drop. It's only 2.86% of my portfolio. However, I am down $133, but it does pay me a nice dividend of 4.22%, and according to analysts, 13 of them are saying that this is a complete buy. As you can see, look at the earnings of this company, it's just great. But again, since it's Chinese, price keeps going down, I'm gonna hold it. I already went through this with Alibaba and I said to myself I was never gonna do it again. Then I bought NEO. It happened, but I managed to get out of NEO profitable, and now I bought this again, and I promise you guys this is gonna be the last time I buy a Chinese stock. I am not going through this roller coaster again. Now, to get started with the ETFs that I have transitioned over, the first one is gonna be the mid-cap 400 index from SPDR. I currently only own 2 shares, which is about 11.27% of my portfolio, and that's going to be around a $1,200 market value. If you take a look at the max history of the chart, of course this is where you would have wanted to buy, but no one really knows what happens. I'm buying it up here. It's not really at the high. As you can see with ETFs, they tend to honestly just keep going up. This one, it has its drops, but after every single time it has its drops, it just makes higher highs. So that's my hope for now. Just make a little bit of income there. And also, one of the main reasons why I'm investing in this type of ETFs and not specifically stocks in general is because I want to be exposed to the whole market, and the S&P 500 just tracks the top 500 companies. I also want to have some mid-cap companies because those companies make money as well and they perform as well. As you can see here in the top 10 holdings, there isn't any really popular name that you would think of that everybody's talking on in YouTube. So these are companies, again, that are helping the economy. These are companies that are making money, and these are companies that I want to be exposed to. Next up is going to be the SPDR small cap value ETF. Again, my average price is about 90 bucks. I have 12 shares, which is about 10% of my portfolio, and the market value of that is going to be around $1,072. Again, guys, if you saw before, if you noticed, I forgot to show you, but one of the biggest percentage in this fund was going to be technology. Here is a complete opposite is going to be financial services. Industrial technology is only 13%. Again, I want to be exposed to other type of companies that are making money. And again, if we take a look at the top 10 holdings, there's really nothing here that you're going to be seeing on Twitter. So again, these are companies that I want to invest in. And also these portfolios, I think the most that they overlap each other is about 2%, excluding the S&P 500. Okay, I'm talking about the portfolios I'm going to show you now. They don't overlap each other at all. That means I have a couple of ETFs that are non-overlapping, so I'm very exposed to different type of companies. Could this be a risk? Of course, yeah. Something bad could happen in the economy and these companies are going to suffer, just like the huge company, the trillion-dollar companies are going to suffer as well. Now, of course, is this not the most popular ETF in the world right now? SCHD, my average cost is $26. I have about 30 shares. I used to have 130. I sold out of about 100, made a nice profit there. It's currently 7% of my portfolio. I wanted to get this to at least 10 or 15%, and my market value is about $820. Now, if we take a look at the top 10 holdings, now here are some popular names, some companies in the S&P 500. Therefore, I don't have an S&P 500 ETF in this specific portfolio, but I'm still exposed to these type of companies that are great companies, almost things that you need on a day-to-day basis, like for example, Home Depot. You need gas, you need internet, you need drinks, you know, sort of that stuff that I want to be exposed to consumer defensive, I guess you could say. Now, this one I showed you guys before. This is the iShares 0 to 3 month treasury bond. Pretty much this just invest in treasury bonds. This is not an ETF that's gonna move a lot. As you can see, look at this, is just up and down, up and down. This is just a way to reserve my money. It's currently 14% of my portfolio. I just want to have this cash here, making a nice 4% return. And then if I do need the money, I can always sell all of it and reinvest in whatever it is that I want to invest to, or maybe even transition to the other ETFs. The current market value is about $1,509. As you can see, this is all United States treasury bills. And I know, as you saw, look at this, the 52-week high is 174 cents and the 52-week low is 115 cents. So about a 16 cents difference is what this moves, but it does pay you a 4% dividend yield, which is a good way to keep some of my money. And then lastly, I just want to have some exposure to the bond market, even if it performs or not. As you can see, throughout the history of this ETF, it has not been very good. However, if I'm going to invest in bonds, it's going to be a time like now where it's almost at all-time lows. My portfolio diversity, only 10%, about 15 shares. My average cost is $74 and my total market value is about $100.16. This is also going to be paying you a nice dividend. So while owning this, you can get paid, and then there's also hopes of the ETFs going up in price. Now, another thing that I wanted to show you guys is my buying power is currently at 11,000. And while you think this is money sitting here, it's actually making a return because I have Robinhood Gold, and I think at the moment they're paying you at 3.5% on your uninvested cash. Not only that, I'm also selling some puts. I don't have any open right now, but I'm going to be looking for some starting this week. And that's also another way I'm going to be making some income. Although this doesn't look like the most profitable thing or the safest way to go about your investments, and it's probably most likely a mistake to sell out of the stocks that I already bought at a low price, because these stocks that I had, for example, ASML, CRM, these are stocks that are probably going to keep going up in price, but I was good with the money that I made. I wanted to reinvest that cash somewhere else, be a little bit safer, because I'm also going through some things in my personal life that I might need the cash, so I want to have that money there. I don't want to lose it, and it is what it is, guys. This is just part of the game. Obviously, you want to invest for the long term. I don't have the opportunity to do that right now, just because this money, I might need it. Of course, you have to invest with money that you're not gonna need, but some things are unexpected in life. I'm 99% sure, hopefully, I'm not going to need it. But if I do, it's there and I can use it. And I already made my profits with the stocks. Just reinvesting into ETFs is a little bit safer. And then I am going to start planning to invest in more stocks if there are value stocks available. Like, for example, Pfizer, UPS, Comcast. I think these are great stocks. And I'm also going to start looking again into NVO. I had NVO. I sold it at a profit. Then I bought United Health. Didn't want to buy NVO because I had Pfizer and United Health plus NVO. Didn't want to have 3 biotechnology healthcare stocks. Now that I sold out of United Health, I might be jumping back in NVO, but I don't know yet. I have to do my research. If you enjoyed the video, please consider leaving a like. Don't forget to subscribe. And as always, I'll see you on the next one.